Imagine this. Over the past few days, hasn't your mood felt like a roller coaster? On Monday, that heavy tariff news hit the market like a thunderbolt. Tech holdings went red across the board, portfolios took a hit, and investors' hearts sank. Then suddenly, one line from Vice President Vance flipped the market around, a full-on rebound, like the crisis had vanished overnight. But before anyone could catch their breath, Tuesday came with another reversal. The trade tension cloud spread even wider. In this kind of policy-driven market, emotion becomes the biggest enemy. But amid all the panic, why is it that some people stay calm? The secret lies in their portfolio structure. They were already prepared for every possible outcome. Losses in tech stocks, offset by gains in hedging assets like rare earths, and their consumer blue-chip positions, rising steadily against the current. Now, in today's video, I'm not here to teach you how to predict Trump's next move. That's a fool's game. What I'm going to share is something much more powerful: how to put a bulletproof vest on your investments. Hi everyone, I'm your wealth strategist, Daryl Hart. Welcome to this week's episode of Deep Think Tank. In this episode, I'm sharing with you the ultimate strategy that allows you to stay calm no matter how wild the markets get: asset allocation. This isn't some abstract theory. It's a practical, step-by-step playbook you can actually implement right away. Don't worry, it's not as complicated as it sounds. Think of it like building Lego. You just follow the manual piece by piece. Everything from here on is pure value, so let's dive right in. The very first lesson in investing isn't what to buy, it's who you are. Ask yourself two questions. First, when do I plan to use this money? Is it for a down payment 5 years from now? Or for retirement 15 years from now? Second, how much volatility can I really handle? In the world of investing, based on your risk tolerance, we can roughly divide investors into two major types: the conservative player and the growth player. These represent completely different philosophies, risk appetites, and return expectations. The conservative player is the guardian of wealth. They see investing as a marathon. The goal isn't speed, but getting to the finish line safely. These are investors with lower risk tolerance, maybe retirees, people nearing big upcoming expenses like buying a home or paying for education, or simply those who prefer stability and get nervous when markets swing. For them, capital preservation is the cornerstone. They aim for long-term, stable, and predictable returns. Their priority is steady growth, not overnight riches. They are risk-averse by nature. Market swings make them uneasy, sometimes even paralyzed. Their motto: better to miss out than mess up. Avoiding downside risk is rule number one. So for conservative investors, their portfolio should be dominated by high credit bonds like treasuries and financial bond, dividend-paying blue chips, money market funds, and index funds, all defensive assets. They need a strong margin of safety, favoring companies with mature business models, stable cash flows, and valuation metrics like PE and PB ratios that are on the low end of historical averages. Conservative investors should focus on short to medium-term flexibility and liquidity, making sure their money is accessible when they need it. Now, the growth players, they see investing as surfing. They're looking for those massive waves that can generate serious momentum. What drives them is capital appreciation, and they live for the thrill of the ride. These investors aren't content with average returns. They're on the hunt for tomorrow's giants, the companies that can multiply in value and deliver outsized gains. They're risk takers, even risk lovers. They understand that high returns come hand in hand with high volatility. They can stomach sharp drawdowns because they care about the long game, the big potential payoff. For these people, I recommend assets with high growth potential, cutting-edge tech stocks, emerging industries like AI and biotech, thematic funds built around future trends, and even small cap stocks. When choosing these investments, valuation isn't the top concern. The focus should be on a company's future market space, its business model advantages, technology edge, and the strength of its management team. Growth players are usually long-term investors. They believe time is your friend. They're willing to hold a company for years, even decades, to capture its full growth potential. This style suits those with higher risk tolerance, younger investors, professionals with stable incomes and extra savings, or those who deeply understand specific industries. Now, there's no good or bad investment style. Some people like driving a reliable sedan, others crave a fast sports car. It's all about personal choice. The key for individual investors is to clearly understand your own risk tolerance, financial goals, and time horizon, and then find the approach that truly fits you. In fact, many seasoned investors use what's called the core satellite strategy. Allocate most of your money, the core, to conservative assets for safety, and a smaller portion, the satellites, to chase growth opportunities. That's how you balance risk and return. Think of your core as the foundation of a house, solid and steady. The satellite is like the garden on your balcony, a space for experimentation. The proportions matter. Typically, the core takes up 70 to 80% of your portfolio, and satellites 20 to 30%. If you're conservative, your satellites might only be 10%. If you're aggressive, maybe up to 30%. This difference is crucial. For example, a conservative investor might hold 80 to 90% in core assets and 10 to 20% in satellites. The core aims for preservation and steady income. The satellite aims for moderate growth. For a growth investor, the core might be 70 to 80%, with 20 to 30% in satellites. The core provides stability, the satellite seeks high upside. Now open up your brokerage account. Look at your total assets. Based on those ratios, calculate how much should be in each category and compare it with how much is there. The difference between those two numbers, that's your adjustment target. But once you've set your allocation, it's not set it and forget it. You've got to check in periodically. I tell people, use your birthday. Once a year, check your portfolio and rebalance it back to your target weights. Say a year later, your Bitcoin allocation went from 5% to 15%, while your bonds dropped to 18%. That means your overall risk is now higher. What do? Rebalance. Sell some of what went up, buy what went down. Or set a rule. Whenever any asset class drifts more than 5% from its target, rebalance automatically. Some say that's against human nature. Why sell when it's going up and buy when it's falling? But that's discipline. That's how you force yourself to sell high and buy low, the true key to long-term success. And remember what we said earlier about the taco? The best way to deal with it is not to put all your eggs in the US basket. Always include exposure to other global markets. That way, even if the US takes a dip, your global positions can cushion the impact. Let's take a 50-year-old investor with moderate to high risk tolerance. Here's how his growth-type warship might be built. Core assets 80%, 40% in US S&P 500 index funds, 20% in global developed market funds excluding the US, and 20% in global aggregate bond funds. Satellite assets 20%, 10% in emerging market equity funds, 5% in crypto, and 5% in hand-picked stocks or thematic ETFs. See how that works? Each piece has its job. This portfolio balances risk and reward, giving room for growth without letting volatility sink the ship. The core idea of asset allocation is simple. Don't put all your eggs in one basket. The market is full of surprises. A single Trump tweet can send it plunging. A single Powell comment can make it soar. If your whole bet is on one asset, say tech stocks, one bad day like Nvidia's recent 4% drop could hit you hard. In this chaotic, policy-uncertain environment, it's easy for investors to feel lost. But the more complex the market, the more we need to cut through the noise and focus on the sustainable macro themes. Shift your mindset from which stock will go up to how should my capital coexist. Right now, we're seeing several signals that might be sketching out the investment roadmap for the next cycle. First, the Fed's rate cut signals. This isn't just a short-term boost, it's a major opportunity for asset repricing. Powell's dovish tone lowers the anchor of the risk-free rate, triggering a chain reaction. Bonds benefit directly since prices move opposite to yields. Falling rates push existing bond prices up, especially mid to long-term treasuries. That's good news for conservative investors. Meanwhile, growth stocks, especially tech, are heavily influenced by future cash flows. When discount rates, treasury yields, fall, those future cash flows become more valuable today. That's why the Nasdaq often reacts sharply to rate cut expectations. Right now is a perfect time to revisit and re-enter fundamentally strong growth names with clear earnings paths. Second, avoiding sectors directly in the trade war crossfire. That's defensive wisdom. Behind it is the bigger story, global supply chain restructuring. Trump's tariff push isn't an isolated event. It marks a new, friction-filled era for globalization. Companies overly reliant on Chinese supply chains, whether they're Chinese firms listed in the US or American manufacturers sourcing from China, face rising costs and uncertainty. Smart money is shifting focus from who's cheapest to who's most reliable. That shift doesn't just mean avoiding those hit hardest, it also reveals opportunity. Look toward companies benefiting from regionalization and onshoring, North American manufacturers, Mexico's nearshoring boom, and Southeast Asia's growing supply chain hubs. Third, gold hitting all-time highs. That's the market shouting two things: fear and distrust in fiat stability. It's not just about traditional safe haven demand anymore. With ballooning government debt and geopolitical risk, gold's role as a non-sovereign store of value is strengthening. It's the ultimate insurance against policy uncertainty. For individuals, having a small slice of gold in your portfolio acts as a stabilizer, especially when the usual stock-bond correlation breaks down. And finally, the most exciting trend: AI's integration into the real economy. Walmart's partnership with OpenAI was a milestone. It proved AI's real value isn't in hype, it's in improving efficiency and creating new revenue streams. This is the start of a new industrial revolution. The future opportunities won't just be in tech companies, they'll be in every traditional business that uses AI to transform itself. Those who adapt fastest will win big. To sum it all up, we shouldn't just sit around waiting for policy clarity. We should proactively position ourselves around these key themes. My friends, the best investors often look like lazy people. They don't chase every rally or panic at every dip. They spend their time perfecting their blueprint, their asset allocation plan. Then, through steady rebalancing, they sail smoothly through both bull and bear markets. Once you have a truly diversified portfolio, you'll notice something changes. You stop caring so much about Trump's tweets or the next Fed meeting, because you know your financial fortress is built strong enough to withstand whatever comes. If you're feeling confused about the market right now, or if today's discussion gave you some clarity, make sure to subscribe and hit that little bell. Every week, I'll bring you deep dives into the latest macro events and practical wealth strategies, from asset allocation to risk management and beyond. Together, let's build a more resilient fortress for your wealth, one that stands tall no matter how wild the storm.